So welcome back, guys. This is Top Boy from Empower FX. I welcome you back. I just made a video on liquidity concepts. Now I'm also looking at a video looking at how to grow $20 to $500 in 20 days. That's a month. We have a good risk management plan which I'm going to be showing you, even do some calculations for you, which is so realistic. If you follow that, you are sure I assure you that you're going to make the $500 if you don't break any rules. If you don't break any rules, you'll make the $500 at the end of the month. Even you can even make more than the $500, so long as you follow the mechanical rules or the golden rules we have come up with, or following our trading plan. But in this, you should have knowledge about risk management. In risk management, what would I say about risk management? I have a PDF here which I'm going to be sharing in the description, in the video description below. If you're new here, please subscribe, like, share, and comment. Thank you so much, so that you don't miss out on the upcoming video. So this is our small PDF here. So it is basically looking at risk management. Also, what is risk management in forex trading? I don't want to go through everything, but I want to hint on some few things that can really bring out the topic of today, because you can't go to that when you don't know what is risk management, because you cannot grow the $20 to $500 when you don't know risky management. So risk management in forex trading is a set of strategies and techniques that traders use to minimize potential losses while maximizing what? Profit. So we are going to be looking at our strategy. I'm using SMC and ICT. How do I basically take out trades every single day, looking at my risk to reward every day? Because I'm using a 1 to 3, we shall be using a 1 to 3 risk to reward. So we shall know what is the risk to reward here. So after that, you should know what is your position sizing. You should know do you know what is risk tolerance? We shall be looking at that. So under risk management, we are going to be looking at how do we minimize the losses and how do we maximize on the profits every single day, or every time we take out a trade. So forex trading involves buying and selling foreign currencies. It can highly be volatile and speculative. So without proper risk management, traders can easily incur significant losses. Here are some of the key components of risk management in trading. So if you don't incur risk management, you're going to get a lot of losses. So that's why many traders have lost their accounts. Many traders have lacked discipline. Every time they're lacking, crying of psychology. Psychology is not coming from the way how we are trading. It's because we have failed to manage our risk. Because if you don't manage your risk, it is going to disturb your mind. Me personally, in the beginning, I had issues of risk management, because I used to enter the trade. I didn't know what is my position size. I didn't know that my account size would take in this as its maximum lot size when I'm trading. So of which many traders are missing out, because many people have looked at flipping as something that is so profitable. There is no flipper who is profitable in this world. No one. It's someone who has made 100 millions. The following day they have taken out 120 millions. Is that flipping? Is that a business? No. Let us be disciplined. Through this discipline, we are going to incur proper risk management. No, I'm having my $20 account. In the beginning, the first week, how much should be my lot size? That's position sizing. Position sizing is going to come with how much is going to be your loss per pip. What is my lot size? Then if you understand those two, you understand that I'm now having a $20 account. I'm going to be using a lot size of 0.03. Okay? How much is going to be my stop loss? With this risk management plan I've come up with, we are going to be looking at a 1 to 3 risk reward. That means that we are going to be losing 10 pips every day, on every trade, and winning 30 pips on every trade. So we are going to say on a 0.03 lot size, if I enter trade and targeting 30 pips, what would be my take profit? Would be how many dollars? If they take my stop loss, how many dollars do I lose on that trade? So that's what I want to teach you today. Maybe you can also integrate it to looking at another account size and integrate it in that format, looking at how many losses can you take in a week and how many wins can you take in a week. And if you take more than 6 losses in a week and you take 2 wins in a week, do you lose your account or the account remains? That's the question I'm going to answer today. The account doesn't move away. Okay, because your risk to reward is a tight one. You're losing 10 pips, winning 30 pips. So that means that if you have like 2 trades, they can cover up the other losses over the week. So that means that every single day we are going to be taking out 2 trades. Okay, that means that we are going to be losing. I don't know, I'm going to be calculating for the pips we shall be losing, so the dollars we shall be losing. If we are to lose 2 trades, those 2 trades a day, and I'll be giving you the dollars we are going to be winning when we take the 2 wins a day. So guys, let us go and understand what is position sizing, and that is determining the size of each trade relative to your account balance is crucial. So looking at the account size, I have $20. I talked about that. What's my lot size? Some of us are putting 20, 0.20, 0.20 lot size. The mini lot, 2 mini lots, you're blowing the account. The moment it goes against you, 70 pips, the account is gone. And also, we are going to understand that how much am I supposed to use the lot size. It helps you so much not to blow off your account and really grow that account. That is what I call compounding. Compounding, if you've heard of compound interest. So compounding, we are going to be looking at compounding. How do we grow the account without withdrawing any single coin for our own problems? So it's very easy, but not easy. So a common rule of the thumb is to risk only a small percentage of your total capital on a single trade, typically 1 or more than 1 to 2 per trade. This helps limit the potential losses and prevent you from risking too much from your account on a single trade. That means that every trade, how much are we losing? We are losing 1 or 2% of the account. Okay, so that's what you're going to be looking at. But for us, you're going to be looking at in terms of pips, not percentages. Are we together? Now, so we look at the lot size. So this is how we can determine the position sizing. So some of us don't know what the lot size is. How much does the micro lot? How many units are there in the micro lot? We have 1,000 units. And what's the lot size? That the micro lot size, that is 0.01. And how many pips do we have? So how many dollars do we have in 0.01 or in 1,000 watt? We have only 10 watt. We have only 10 cents per pip. Okay, so that means that every pip we take on this amount, we are losing 10 watt, 10 cents on a 0.01 watt lot size. So when you go to the mini lot, that means that we are going to be losing 10. We're going to be losing $1 per pip. Then when we go to the standard lot, which goes for 100,000 watt units, that means that this is the standard lot, which is 1. Here we are losing $10 per watt per pip. So just know that some of you are putting like 4-5 standard lots. You want to, an account is just only $100, guys. How many pips do you want? You want only 10 10 pips to be washed out when you use this standard lot on that small account of $100. So you should learn how to calculate your pip, your lot size. And so look at your account, count the lot size, and know how much I'm going to be using on that account, depending on the size. Now, for example, I've given you here, this is a small table. I said I'm going to share this one in the link in the description below, so that you can go ahead and learn and read more about this. So this is an example. We are buying GBP USD. The account size is $100. So we are going to be using, I think, the loss per trade, which is going to be 1%, which is $1. But I'm not going to be following the percentages. I want us to follow the lot, the pips. I'm going to be following the pips and the dollars I'm losing, basically. So how much is 1 pip in dollars? So we are saying that 1 pip is going to be going for 10 cents. That is when we go to the micro lot, this one, which goes for 1,000 units for this currency when you're buying that currency. So that means that 1 pip is going to go for 10 cents. So what is our stop loss? Stop loss size is going to be 6 pips. Okay, for example, let me say we have entered a trade. That is the GBP USD trade. And what would be your stop loss? Maybe our stop loss is 6 pips. So we're going to now calculate, because we already understand that 1 pip is, because we said 1 pip, that is the loss per pip. 1 pip on a micro lot, that is when you're using 0.01, you're going to be losing 10 cents. Now you have 6 pips and you've entered one position of 0.01. That means that you're going to be losing 60 what? Those are 60 cents times, maybe let me say you put in two positions of 0.01, so that means that you'll be losing 1 point, sorry, you're going to be losing 1.20 cents altogether. That's on a trade. Then our take profit would be 32 what? 32 pips. So 32 pips, that means that you're going to be now using still the other standard, our micro lot, that is which is 1 cent per pip. So you get the cents times the pips. So what do you get? You're going to get 3.2, that is per pip altogether. So what you do is you're going to multiply this one by 2 what? By 2 positions. So what is the end result? You're going to be getting 6.14 cents. So that is $6.4 in as you take profit. So that is when you use 0.2. Those are 2 positions here. So and your take profit is 32 pips. There I did some calculations here probably, but I'm going to do the calculation on the other side. So you'd be earning this 6 pips if you hit your take profit, and if you hit your stop loss, you'll be losing that. And that one is okay with 100, with your 100 what lot size, with your 100 what, sorry, account here. So guys, that is something small, though I've not taken you through how we calculate this, but just understand this from this table, that if you're using the macro lot, which stands for 0.01, you're losing 10 cents per pip. Then for the mini lot, this is the 0.01, you're losing $1 per pip, and when you're using a standard lot, you're using $10 per pip. So guys, so this was a small explanation. If you had your stop loss as this and you used the 2 position, that is 0.02, you would have lost this 1.20 as your stop loss. The profit should be 6.4. So we need to understand, when you're doing risk management, never forget to use the stop loss orders, because these ones are helping us to minimize the risk. Okay, these ones are automatic. They're telling us this is automatic, whereby it just breaks up, so it takes you out when the price taps that price you had put as your stop loss. So the take profit takes you out when it hits that target you have anticipated where price would go. So we have diversification. This is avoid putting all your capital into a single trade or currency pair. Diversifying your trades across different assets and currency pairs can spread the risk and reduce the impact of a single trade's failure on your overall account. So that means that, for example, like on our $20 account, we can get 2 pairs. And you see, we are trading GBP USD and we are trading gold. So if gold fails out, GBP USD will work out. That's what they're trying, diversifying, that is spreading the loss to not in one asset but in different assets. In case one of them fails, another will take a trade. But for me, I would always want to take one trade, but it's better this way. When you take 2 trades, I don't stop you from doing that. You can either be selling USD JPY, you're buying GBP USD, which is very fine and very okay, but don't change the lot size. It should remain the same. Good. So we have the trading plan. So you should have a trading plan. Me personally, I have a trading plan I'm using to take out every single trade here. So I would take you through that, but now I didn't display it here. So maybe in the future videos I'll be showing that. So we have what they call the risk tolerance. But before I go back to the risk tolerance, a trading plan is crucial. Most people don't know what is a plan. A plan is basically looking at your rules set by you as a trader, that if I'm to take out a trade, me personally these days I'm using the quarterly theory, that is ICT basic, but I'm combining it with SMC structure. I want to see where the market, the bias, the directional bias, where is the market moving next, what is my next door liquidity. That is what I'm looking at. Then my plan is telling me that you should have, maybe you should be within a higher time frame PDRA, maybe a 4 hours fair value gap, maybe order block, something like rejection block, depending on anything according to the PDRAs. Then my entries, I would take my entry on a 1 minute, maybe from 5 minutes to the 1 minute, to have a good risk to reward ratio. It's my plan put in place that I'm following every single day. So you can never pass this challenge if you don't have a trading plan. If you don't have a strategy, in short, you won't pass the challenge, because you want to enter any trade, because you need to have some rules you're basing on, some principles you're basing on. Trades you're taking, are they in line with what you plan? Is the time you're trading, is the right time you're going to plan? Don't take these trades in the morning whereby the spreads are high. Okay, wait for spreads to reduce maybe during the London, and you take some good trades. So that is something I do advise traders to do. So risk tolerance, it will be my last thing I'll be looking at. Sorry, let me go through everything here. So there are not very many. So we have what they call the risk tolerance. Tolerating a risk, that is, you should accept you as a trader that me, I've accepted to take this loss of $5. You accept that. You keep quiet, move to the next trade. You take the loss, accept the loss. But most traders have failed to accept that I have to make a loss in the market. Yes, you have $20. You've lost. Your stop loss has hit with your 0.03. You've lost $3. Accept that. I say, no, me, I've accepted. I'm losing the 30 what? The $30. So when you lose the $3, you're fine with that. That's tolerating the risk. Some traders don't accept that. They don't want to. You cannot afford the loss. You keep in the bed sleeping. So Forex is a scam. What make? I never trade again. This mate, I think he's also lying. Why am I always making losses and he's making profits? No sense. I'm sorry to say that. Accept the risk. Move forward. Backtest. Ask yourself, why did I lose? Don't go back to looking at crying. The problem is what? No, fix the problem. If you're the problem, go and study. Go research. Why did you make a loss? If you know why you made the loss, that's the best way of learning. And that's how I've learned. And that's why and that's what most traders, that's how they're progressing. Moving from one level to another. Don't think that we are here just because we know things. No, we have gone through a lot. We have made losses. That loss you make today, sit down, don't move forward, sir. GBP USD I have made a loss. Those are just simple losses. Ask yourself, why? Did you follow structure? Were you trading within what? Price was reacting from where? Those simple things teach you a lot. At the end of the day, you are going to come out as a successful and profitable trader. So another one, monitoring and analysis. So you first continuously look at the market, look at your calendar every single day before you take the trades, monitor your trades. You can always adjust the positions, look at the market conditions. If there's news, you can even close. Sometimes you can always move your trade at break even. If you hit your target and you see that the market is still moving lower or moving higher, you can move your stop loss to the 30, to your target, daily target. Maybe if they come back and they hit that, it's okay with that. But if the market continues, you can go on moving on, trailing stop loss, moving your stop loss, trailing the stop loss, whereby you're trying to maximize more of the profits. That is it. So another one is use of leverage. So some of the traders have gone unlimited leverage. You know, XNS has given us that my link is in the description here. So if you want to register XNS, if you're a trader, please, you can use that. It has the best spreads, highest withdrawals. So the fastest withdrawals. It's the best. I don't know how I can define that. It is the best in Africa, even abroad. So the fastest withdrawals, you can withdraw deposits. The customer care, the response time is the 24/7. I don't want to talk more about XNS. The link is in the description below. You can register. So the leverage, guys, it gives you unlimited. So most traders have misused this one because they want to flip, they want to enter more positions. Look at the leverage. On this account, I would wish you to use a 1 to 5. The highest you can use 1 to 500. Use 1 to 500 as your leverage here. So that is how you can use this small PDF of mine, understanding your risk management before you start on the other account growing it. If you can't understand that, then you have a problem. So we have the risk management tools. The brokers offer risk management tools such as guaranteed stop loss orders and trading stop orders. So like what I've talked about here. So let us go back to our trade. So let us come back here, understand how do we grow this, how do we grow that small account of ours to that. So like I told you before, we are going to be using I'm going to go back, display for you our plan, what we are going to be using, but we want to grow this one from $20 to $500 in 20 days, which is very easy. I said you can even make more than $500 depending on the market conditions and how your trades you've taken every single day. Because for me, I have come up with a plan, okay, with a risk management, looking at the position sizing, tolerating the risk, looking at the risk to reward, using the stop losses, looking at the calculating pips. So I've not talked about the risk to reward. I don't know if I've skipped it. Risk to reward, God. Okay, I skipped risk to reward, guys, here. So first and foremost, understand your risk to reward ratio. Because what are we looking at? We're looking at what are you risking in the market, and what is your reward. Okay, we are risking at 10 pips as our stop loss altogether. I'm saying we are risking. Let me first clean out this. Our RR. Sorry. Our risk to reward. We are looking at it. We are risking 10 pips. 10 pips in the market, and we are winning 30 pips. Sorry, 30 pips. Okay, so 30 pips according to our lot size, because we are going to start first week. We are going to start with 0.03 as our lot size on every particular trade you are going to be taking. For example, now this is, like I told you, we are going to be using the micro lot. The micro lot goes for the loss per pip. The LPP loss per pip goes for 10 cents per what? Per pip. That is when we are using 0.0 what? 0.01. So for example, here we have 3 positions of 0.01. So indicating that these ones are our positions, indicating this one what? Position. So if we hit our stop loss, how much is our loss? So 0.03, you're going to get the 10 pips times, now you convert the lot size back to the cents. That means that we are going to have 10 what? We are going to have what? We are going to have 0.03. That is going to be 0.03 cents. That is 30 cents per what? Per that is now per pip altogether. So per pip we shall be losing 30 cents. That means that for 10 pips we shall get the 0.03 times the 10 what? The 10 cents. Let me get the calculator here so that you can do the calculations clearly. Let me get the calculator here. So that one, I think that one, those are like 3 pips. So 0.03 cents, 0 times 10 pips. So that is 3. Those are $3. Those are $3. We are losing on this trade. If we are to lose, that is the risk to reward. So tell me, if you're losing $3 on every trade, how many trades do you want to lose out your account? Okay, so you're going to get, how many trades do you want to lose your account if you're losing? Let me first clean out this. Now let me say that we have $20 divided by 3. You need 6 trades to lose that. Those are 3 consecutive days. I don't think that we can lose 6 trades in a row. That's a strike. I don't have it in my trading. I lose 2 trades in a row or 3 trades. That is maximum. But now we want 6 trades to lose if we are starting off with our risk reward in that format. So I was still telling you, so risk reward is so important. So know how much you're losing and how much you're risking. Like I told you, me, I'm using a 1 to 3. Someone else will be using a 1 to 2. So a 1 to 2, you'll be looking at 20 pips, but a 1 to 3, you're looking at 30 what? 30 pips every single day. They are there. The 30 pips, you will get them. I'm going to be trading with this with the effect from next week. I want to start up a fresh week and start that one, calculating a full month so that I see if the $20 can be flipped. I've tried that one before. It worked. Again, I'm going to try it again. It will work. It's a must. It works. It works. Follow the plan. The risk reward is here. So the risk reward is before entering a trade, the traders should determine the potential reward in relation to the risk. A common rule is to aim at the risk reward ratio of at least 1 to 2 or 1 to 3, meaning that for every dollar you risk, you aim to make at least $2 or $3 in profit. This helps to ensure that your winning trades can offset the losing trades over time. So that means that if we are losing, maybe if we have lost 2 trades, because your risk reward is okay and you have lost $2, like the other one trade can cover up the loss, again you find out you're in some other what? Profit. So allow me take you through the plan so very fast, so that I don't want this video to be a lengthy one, though I've not taken you through the calculations of everything, how it is supposed to be done calculating, but you go back and go through this, understand everything from this. What is your loss per pip? Understanding this, when you see you have 0.01, that is your micro lot. So that's why everything, the origin is from this small table here. So when you understand the table here, you will know that I'm entering the trade with these and these dollars, and I'm supposed to enter with this. If I'm using the micro lot, how many positions am I going to open? 7 positions. That's the 0.07. One position, but you can put 7 of them, but they also present 1. So you see, if they hit my stop loss, I'll be losing this. If I have a stop loss of this, and simple math, do the math before you enter the trade, and you'll lose money. So so this is it. So our position sizing, our account size is $20. So we are going to be using the micro lot. Our position size, we are going to be using the 1000 units, standing for 0.01 as our lot size. Loss per pip is going to be 10 cents per pip. So that is 1 pip is equal to 10 cents. So our mini lot, I talked about that one in the table. You can go through that. But for me, I'm going to be focusing on the micro lot for now. So when you're buying your USD, for example, lot size is 0.03. So what is the loss per pip? It is 10 cents. Just get this one times times the pips altogether. So we have 10 pips. So not the pips times the cents altogether, because we said that the micro lot has 10 cents. So we have how many cents are these? So these one are 3 micro lots. So that one is the first lot. The first one is 0.01 plus 0.01 plus 0.01. Those are 30 cents. That's what we are seeing as our loss per pip is 30 cents. So we have a stop loss of 10 pips. What would be our loss? Our loss, I calculated for you, it is 10 pips times the 30 what? The 30 cents we have on these 3 positions, because we are losing 30 cents per pip. So that means that then for the 10 pips, we shall be losing $3. So if it's our take profit, we shall be looking at this, the 30 cents again per pip. Then we shall be winning $9 for 30 what? Using a 0.031 position like this, you take out your $9. So what is our risk reward? It is a 1 to 3. That's what you're going to be following throughout the entire the entire 20 days. So our account size starts weekly calculations. So it's week 1. So what is our account size? Our account size is $20 in week 1. So for example, day 1, that is our Monday, we enter. The first day we make a loss of, we make 1 win. The day 1 we have 1 win and 1 loss. So as remember, we said when we make a win, because remember we have we've already calculated. Let me just take you back here, because we remember here, this is something we need to look at. What is our loss per pip? We are losing 30 cents per pip, and we are having our stop loss as 10 pips and our take profit as 30 pips. So we should understand how much should be our loss, because if you lose a trade here, that means that trade was supposed to win how many pips? It was supposed to win 9. If it was to take us in profit, it was supposed to lose $3 if it took us in loss. So that means that we had 1 loss and 1 win. That means that those we had $9, then again we lost on the $9, we lost again $3. That is this loss, taking us to $6. That is our first day. We have $6. So the account now is 26 what? It is $26. Now we go to the next day, which is Tuesday. We are winning 2 trades, all of them. That means that we are winning 9 plus 9, taking us to 18 what? $18. We go to the next day again, we have 2 wins, taking us to $18. Again, the 4th day, that's the Thursday, we made 2 losses. We were stopped out twice. So that means that we are losing again the $18. So we go on the 5th day, that is on Friday, we again win 2 trades. That is, we are taking a win. So it is not happening like this. I'm just giving you the calculations. So how many losses can you have in a week? Though these are 3 losses. So if you have 3 losses in a week, although there are 4 losses, it will depend on any, because I've gone playing out with the days. So what would be your account balance at the end of the day? So your wins is this $60 minus this 18, so you go to $42. So the account which has been at $20 has now moved to $42. We go to the next week with our $42 ready to trade. Now the account now has doubled. In fact, it has doubled in 1 week. So we are at $42. So in $42 the second week, so we still go with the same criteria: winning, two wins, two wins. We have one win, one loss. Still, we have again still used the same. We have not used the same lot size here. We have changed the what? The lot size, using now 50. Now the first week we are using 0.03. This one we are using 0.05 because the account has grown. We can also increase on the what? On the lot size. We have increased it by 0.0 what? 0.02. So that's what you see. We are trading it at this amount. At this what? At this amount. So that is now we are using a lot size of 0.05. That is, we are losing 50 cents per pip, and we are winning 30. So that means that we should look at our risk to reward. So that means that how much are we going to be losing on each single trade, and how much are we going to be losing on each single trade. So this is our win. So for this week, we are going to be winning we won $66. So when you get the 42 plus the $66, it takes you to 108 what? Dollars. That is week 2. Now we again move to the third week, still moving using the same risk to reward 1 to 3. Don't move from that. But the lot size you won't increase because we need to. The money has to also grow, okay, depending on the account. So you don't be on a constant lot size. You can do that, but don't go out of this if you want to win the $500. Don't go through out of this league. So try it out. You tell me at the end of the what? End of the month, or at the end of the 20 days. So after that, you have the third week. We have increased the lot size now to 0.08. That is, now we are losing 80 cents per pip. So the loss here, as you see, everything is calculated. I think this one I'm not going to share this you can copy these ones. I'm not sharing this one. I'm going to share the other risk management plan. So at this one, you see we are going to be risking $80 per pip, winning $24. So what happened? This is how we worked out the whole week. So we are at we made a win of $176. So when you get 176 plus the $108, we are moving at minus the losses. So we are going to go to $284. That's the second week. Can you imagine? Now, so that's the third week. That's our last week, whereby we are going to increase the loss now from 0.8, because the account has doubled. We are going to take it at 15, 0.15. Now we have moved now from our micro lot. We have gone to a standard lot plus 5 micro lots of 5,000 units altogether. So that is, now we are looking at 0.05. This is it. So we are going to be losing 1.5 cents, or $1.5 per pip. So for 10 pips, we shall be losing $15. Then for 30 pips, we shall be winning $45. So this is our win rate. At the end of the day, remember we came back with our 284, and we made a profit of this, because remember here we had some losses, also 3 losses and the wins. So it doesn't work out. This maybe this one worked on the first day, the other one works on the second day, but just try out to use a strategy. It will work out. You can even have only the wins and you don't have any loss throughout the week, which is okay, because me, I'm going to be trading only the silver bullet, that is the London and the New York AM, either even the PM. I'll be seeing what to do, but I'll be playing out with very many pairs. I won't be using one constant pair. I'll be using very many pairs to trade this, okay? Because I want to spread the risk to other what? Diversifying, like I told you in the PDF here. So that is our 270 plus this one. It takes us to $250. So that's how you can turn your $20 to 500. In fact, you see we have a profit of $550. Even your capital is back. You have even a bonus of $30, even $500. So you can again go ahead, make another risk management plan for the $500, and you say that I want to grow this amount to a bigger amount, maybe to $5,000. Simple. Come up with a management plan. So you know that this is what I'm going to be risking. How many trades do I need to blow out the account before even I go for any other trade? So if you are to trade, like in the beginning I told you that you are going to risk, for example here, you're going to risk how many trades do you want? You want 6 trades to blow the account. Those are 6 trades. In fact, there can be even 7 7 trades. You want 6 trades to blow the what? The account. And those are 3 days. I don't think in 3 days you don't have a good what? You can get only one trade that can cover up this loss and you even get some profit. So guys, that's how we can grow our $20 to $500 in a period of a month or 20 days. But you follow this small plan of mine. In case you want this plan of mine, you have to find it in my Telegram channel, my free Telegram channel. I'm going to send it there today. You can check it for it there, but the PDF is going to be linked here in the video in the video description also. Thanks for watching. So that's how we can grow our account. I said again, through these profits you can get these profits again, also make another small plan for them, then grow maybe from 500 to 5,000. So I'll also come up with that one later, maybe when we grow this one to that amount. So thanks for watching guys. Subscribe, like and share the video. So thank you so much for watching.